Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep. With your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. Good morning, everybody. Welcome to this Thursday edition of Benzinga's Pre-Market Prep. Spencer Israel here with Joel Elconin and Dennis Dick on today's show for the first time in I don't know how many days. We couldn't get a rally going overnight. So we'll talk about that, the lack of an overnight rally, what it means going forward here. We also have earnings on our plate. Smile Direct Club, Cisco after close yesterday, Norwegian Cruise Lines this morning. Don't forget about Jobless Claims at 8:30. And our guest is Marc Chaikin. He will stop by at 8:15 to give us his take on these markets. Let's bring it to Joel here. Joel, as I mentioned, no overnight rally.
Just the opposite, Spencer. We're trading down 14 handles here at 27.99. One little measly pop up to 29.25, but that was it. Looking at Wednesday's low is still the key number on the downside. That's 27.86. That's our old 50% retracement number. So you can't forget about that. Below that, things open up. Believe it or not, our 8-day low is down at 27.71. So trying to hold on here. Definitely some bearish talk yesterday took us down. Crude staying up, though, up 79 cents at 26.47. Gold in the green by 5.10 at 17.2150. Silver in the red, in the green by 5.9 cents at 15.73. And don't look now, but Bitcoin's battling back to 10,000, up $545 at 9,810. And Triple D, my first question to you is, did you get to listen to me on Hot Mic yesterday?
No, but I downloaded the app now. So I am now following Joel Elconin on Hot Mic. So I downloaded it last night. And what's the code I had to use? Joel. Is it the same code every day?
Yeah, well, yeah, you just sign up for once. It's Joel, capital J, capital O, capital E, capital L.
I didn't put capitals, but it worked for me.
Yeah, 317. And it was tough yesterday because what I'm doing is I'm commentating on what CNBC is talking about, as well as throwing in some other relevant financial information.
Why can't you just talk about the markets? Like, why can't you just comment on what you're seeing in the markets?
Well, what their app is what they're trying to do it is make it for broadcasters.
But you'd be broadcasting the markets.
Yeah, broadcasting the market, but they want to use TV and see if, TV drivers, if people want a different opinion. Like right now, I'd be talking about Mo and what he's saying, but I'm not covering it. But it's good because during the commercial breaks, I could do all my stuff. It's you got to use Apple Play or Google Play to get it. I'm asking them how to get it on the PC, but I hope to see more people in there today. But Dennis, man. Everything's red today. No overnight bounce. You were not running your buy program last night?
Somebody wasn't running their buy program, or if they were, there was just too many sellers. We know we've been talking about this market getting jacked overnight. It seems like every single night we wake up and we're up 20 handles or 30 handles, and then we leak it back. Yesterday was the same story. They jacked it overnight. They tried to jack the stocks more. Obviously, we're talking about that. Couldn't even hold the gains in the pre-market. Eventually, all the stocks opened red and just continued to crater. There are so many concerns here. So here's the good news. I'm going to give you the good news and the bad news. What do you want first?
Give us the bad news.
Well, the bad news is it feels really heavy. And it feels like the rallies are getting sold. And it feels like there's a lot of concerns out here that are starting to obviously, leading the charge as the banks. But let's start with before I go into that detail, because the good news is really quick. We're at support on SPY. We are at the bottom of the trading range. We kissed the low from May the 4th yesterday, 279.13. We bounced right off of it at 278.96. So for you technical traders, we bounced right off of support yesterday, and we bounced pretty hard at in the last hour. So that was the good news. It was a nice bounce at support. But the bad news is the longer you hang out here, the more it feels heavier. And with the banks going down every single day, I mean, was yesterday capitulation Wells Fargo? Well, you'd hope so, but no, it's down another 2.5% here this morning. So, I mean, we've just been talking about the Wells Fargo chart for the last 2 weeks, and or at least the last week, and it's been leading the charge down. And the other banks are starting to follow suit here too, and they're starting to get really ugly. And not only that, you've got Warren selling banks now too, apparently, because Warren Buffett coming out in, I know we're going to get 13 out, so we'll get a little more information, but in his disclosure last night on his Form 4, he sold 497,000 shares of USB. Full disclosure, I am short USB. That's just a day trade. Just because Warren's selling, I'm selling short term. Continue. What are your thoughts here? The banks are the problem. I'm going to tell you. Yes, the virus is the main problem. The banks are a major problem for this market. I tweeted out a week ago. Actually, it was like back on May the 4th. I tweeted out. I said, tech cannot hold us up forever.
Man cannot live on tech alone.
If the banks continue to crater, eventually the market is going to follow suit. Tech has been holding us up and holding us up and holding us up, while the rest of the stocks have not, a lot of the stocks have not been doing well, but the banks have been doing horribly. We look to me like we have a coin flip here on whether we're going into financial crisis part 2 or not. I mean, you know, the economic numbers could easily bring us into a financial crisis. The market has ignored all of that. Maybe it continues to ignore it all, but these banks got some serious issues.
It's reflected in the price from their. I mean, what it depends what their exposure is to some of these retail companies. It's just it depends on what their exposure is to oil companies, right?
It's high. Well, it's not low.
Yeah,
we know they raised their reserves.
Aren't helping. Interest rates aren't helping.
Not at all. Negative rates. Trump's talking about negative rates yesterday. What does that mean for the banks?
Powell said not so fast on that.
Yeah, Powell said, but we know who actually seems to call the shots. Eventually, Powell gives in because he values his job. We saw this before here too. Pressure from the Fed, from Trump has always, Powell seems to buckle under the pressure. So we've seen this in the past. So what's the bull case here for the banks? Tell me. Bank buyers, besides looking at valuation and saying, how can you go wrong buying Wells Fargo at an 8.9? No, I was going to say 8.5, but it's 9.2% now, the dividend. It's almost 10%, the dividend on Wells Fargo. I'm going to tell you today that dividend is not safe. 9.28% dividends are hardly ever safe. And in a chart like this, that dividend is not safe.
And Dennis, you know what's interesting here? So remember how the big banks all set aside billions for loan loss provisions in their earnings report as of the end of March? Wells Fargo set aside the most of the big banks. They set aside the most money for loan losses as of the end of the first quarter. They set aside $4 billion, which is more than every other bank did.
They know about it, and that was a tell.
They know.
There's some storms coming their way. And they could see, and they obviously setting aside. They know the storms are coming their way. You know what? The shareholders know there's storms coming their way. It's going to be very interesting to see if Warren Buffett has done anything else. We know he sold the airlines. We know he sold just a little bit of USB last night. We didn't sell right out. He just sold a little bit, but his little bit is 496,000 shares of USB. But the question is, 497,000 shares. The question is on Wells. Is he holding? Is he just, because Wells is a big position for him. It's getting smaller every day, and you can look at his, obviously his holdings and you say, oh, wow, he's doing really well because Apple, is a huge chunk of his holdings. Well, the Apple's one of his only holdings that's actually been doing okay. He's had a really rough go of it here for a bit. I'm definitely concerned about the Wells Fargo chart and how it goes down every day. I think it has repercussions for the overall market.
Right. And they all did not react well to earnings. JP Morgan was the darling of the group. That went down. That's down another $1.65 today, trading in the pre-market 82.38. And these things got hit with the market. They didn't come back as much. So that's another thing. So I don't know. Look at your XLF. That thing is just hanging there. I haven't looked at that technically in a while.
Remember, XLF is full of Berkshire. I believe the biggest holding in XLF is Berkshire, so it's not a pure play on banks. Sure. If you look, it might hold up better. But if you want to go, find a better play, you can look to the regional ETF, KRE, KBE. Those are all regional banks. Gives you a feel for what the smaller bank is doing. If you want a bigger one, VFH, Vanguard Financials, but that also has some MetLife in it. It's hard to get these pure plays on the ETFs. I'd say if you're looking more pure, you can probably look to the regional bank ETFs, KBE or KRE, and both of those are ugly there too. So it's not just a Wells Fargo problem. It's an overall bank problem here. And it makes sense. I mean, like I said, you talk to some bankers out there. Everybody's got a banker buddy. There's not much going on right now. You're not getting, obviously we're all locked down. There's not big deals happening from an M&A perspective to help the investment banks. There's not, and there's not a lot of little deals happening because, companies aren't looking to expand right now. They're looking to survive. So this is a very, very tough environment for the banks. And I think, a lot of these banks are sitting down here. And if you look at, at valuation metrics, you're like, wow, how can you go wrong? I'll tell you how you can go wrong. Go to the financial crisis and take a look at what banks did during the financial crisis. You can go wrong. Citigroup never came back after the financial crisis. Yes, it's a $40 stock, but the reverse split makes you think it came back, but it never did. On a split adjusted basis, I think it was 10 for 1. It's still $4 from 40. So if you bought Citigroup before the financial crisis and saying, well, eventually it comes back, you were wrong. It never came back. What's the all-time high on Citigroup?
Oh, you always ask me this. It's
well, because I'm trying to pound in a point.
I know.
500.
I should know this by now.
I got 591.
That sounds right. $591. It's $40. So you're still down 93% on your money if you bought it, a few months before the financial crisis started.
That's from the
highs.
That's from the dot-com bubble.
No, that was okay, yeah, but okay. So it maybe never even got back to where it was in the dot-com bubble, but the financial crisis is where it really took the fall. So the dot-com bubble, everything was, obviously the banks never got back there maybe to those prices during the financial crisis. But you can look at it there. It got close to it. So it was like 550 or something, 2008. And then you can see the big fall from the financial crisis, and it never came back. People think, newbies look at it and say, oh, it's $40-$50. It came all the way back. No, reverse split. So you can see that chart is accurate. The stock never came back. So don't kid yourself. On some of these banks, there is major, major problems here. And the stocks are telling you that. And people keep saying, well, the market can go up without the financials. I completely disagree. They can go up if the financials stay pat. But if the financials keep going down, there's problems. If we go into a financial crisis, it's going to bring down the entire market, and it's going to bring down companies. I traded through financial crisis, so I learned how to trade this. Companies with a large amount of debt in a financial crisis are the ones that are in trouble. If you look lately, what's been happening, they've been slamming stuff with a lot of debt. And people are hiding out. I'm going to tell you some bad news here, guys. People are hiding out in the gold miners. They are hiding out in the GDXJ saying, well, this is going to be one safe area. If we go into financial crisis part 2, all those gold miners are highly leveraged. They will get slammed. So don't think you're safe in the gold miners. You might be safe in gold, but you will not be safe in the gold miners. And look at what the gold miners did back in March. People say, oh, that was just selling everything, $40 to $20. No, because in March, we were concerned the financial crisis part 2 was coming quickly. And Fed helped us out, and we've delayed it a bit. It's still not off the table. I would not want to own any gold miners right now with the banks like this, because it will be an issue. And don't kid yourself, that move in March could happen again in the GDXJ if we go into and the GDX as well, obviously. Yep. If we go into financial crisis part 2, the GDX looks like it's ready to fall off a cliff here to me. So I'd be very cautious. Just because gold goes up doesn't mean that GDX will go down. The banks continue to go down. I believe GDX and GDXJ will start to go down too. So it's not safe. You're safer in gold than you are in the GDX.
All right, you did a 14-minute on banks. This was sponsored by Bank America, JP Morgan, and Wells Fargo.
I'm sure they love Dennis right now.
They love me. I'm gonna get a Christmas card definitely from Wells Fargo. For all the tweets that I've been doing, I better get a Christmas card from Wells Fargo.
All right, we got Marc coming on in a minute here.
I want to get Marc's thoughts. Bring Marc on.
Do we want to cover
right
one stock?
No, the stock we've been covering, and we just cover like 10 stocks, all the banks. I got to get Marc's thoughts on the banks here, because we got to stay in this, because people are talking COVID, people are talking a lot of things. The problem right now is the banks. I think that's the overall problem here, and I want to hear what Marc Chaikin has to say about this.
Well, you can, because he's here. Marc Chaikin is the founder of Chaikin Analytics. Marc, good morning.
Good morning, Bears. This is the bad news Bears this morning.
What are your thoughts on these banks?
They look terrible, and the loan losses were just the first shot in the first quarter earnings reports. They're also playing the 2008 game. I don't know if you saw last week that a consortium of banks wrote some sort of paper for I think it's MGM Casinos, and they were forced to sell off the lower grade tranches and take a big loss. So it's not just consumer losses, it's not just energy losses, it's the banks playing the same games that they played in 2008, doing, you know, a big credit default swap tranche, and then having to, because of liquidity concerns, having to take a 27% haircut on about 200 million of a billion issue. It's, the banks are a reflection of what's really going on in the economy, not the S&P 500.
So what does that mean here? I mean, we've had a significant rally, and I know, you know, we've talked a couple of weeks ago, and we're still in the same spot where we were when we were talking a couple of weeks ago. We kind of just range bound, you know, we get a little rally. Tech tries to lift us, and then the overall, you know, other sectors bring us back down. Then tech tries to lift us again, and the other sectors bring us back down. You can feel the push-pull. Tech is the one strength that has been holding up the market for a long time. We kind of lost that leadership in the last few days. I mean, we saw Apple get hit. Obviously, you know, some of these, you know, COVID hiding places are still holding up, like Netflix, Shopify, Amazon, but we have lost a few of the tech stocks. The NASDAQ has got hit the last couple of days. Is this just a pullback in tech to buy, or is tech eventually brought down by the overall market?
Well, first of all, we're not exactly in the same position we were 2 weeks ago. We've made 3 attempts to break through the 2,900, 2,950 area. And in doing that, breadth has started to deteriorate. In the subsequent sell-off of the last 2 days, the average stock in the S&P, X the 6 big names, down 8%, with the S&P down 4%. So that tells me that big tech is holding up relatively better, but that's not a good thing at this point. And I also think that we're in this trading range between 2750 and 2950, and they're working their best to protect that 2750, 2800 level here as we head into the unemployment numbers. If we break 2750, then, you know, I think we go down to 2550, 2600, which would be a 50% retracement of the advance from the March lows. So I really think you've got to look at that range and monitor the market as it tries to hold the bottom end of the range here. I'm not optimistic. Yesterday, you got your first dose of reality in testimony before Congress from Powell, from Fauci. You got the real picture, not the 6 o'clock, let's pour some maple syrup on the pancakes picture. And it's not pretty.
What if the Fed just fires off more bullets? Trump was talking negative interest rates yesterday. The Powell kind of seemed like he wasn't interested, but we know if the market gets ugly, the Fed will fire whatever bullets it can to bring this market back up. It's such a difficult short trade when you're fighting the Fed the whole time. Does the Fed eventually, you know, the bullets they're firing just not give as much impact here? Thoughts on, you know, fighting the Fed if you're bearish?
Well, I think shorting the market with the SPY is a very tough thing because those 6 stocks are holding it up.
Yeah.
And you don't know when that's going to crack. You can't fight the Fed, that's for sure, but there's only so much the Fed can do unless they want to go in and buy SPY, which is being bandied about. And that's part of the reason the market, you know, has had these periodic spurts, because a number of people like Janet Yellen suggested, well, maybe they'll do it. That was 3 weeks ago. And there have been questions to Mnuchin and to Powell, would you do it? And, you know, the comments have been tepid. Well, our inclination is not to go that route. But yeah, they could step in and buy, but that doesn't mean you have to be an aggressive trader on the long side. It's almost like you're looking at triage and praying that the patient survives. And you don't want to root against the patient, but on the other hand, you don't want to make that bet that the patient's going to die, because triage works sometimes.
So how would you be playing it at this point in time? I mean, fighting the Fed to short the market, but buying here with all these problems doesn't sound that great of an idea either. Just my own perspective, I'm playing with a lot of cash because I have uncertainty. My trading portfolio, I'm always trading, but in my long-term investment portfolio, I'm sitting with a ton of cash. I've been sitting with a ton of cash for a long time because I don't like the overall picture. Is cash the best place to be? Or if you're a long-term investor, put your long-term investing hat on.
Well, we've been
What are
saying,
your thoughts?
I've been saying since early March that you should have a minimum of 20% in cash. In my wife's account, because she manages our money, so this is full disclosure, she was 50% in cash, but some of her biotech stocks like Regeneron and Vertex
Right.
have spiked up on earnings to new highs. So she's just sold the spikes, and she's actually more than 50% in cash. So my comment last night was, if you want to get back toward 50%, buy the QQQs on a dip, because at least there you get the pure play or the purer play in the 6 big tech stocks that are driving the S&P plus biotech. So biotech is clearly, to me, a more interesting play longer term and from a trading point of view, but you have to buy them on weakness. And in all these stocks, you get periodic bouts of selling. But there are tons of solid biotech stocks that you can be buying here. And it's the old names. It's Microsoft, it's Adobe, it's Amazon. Notice the chart in Amazon sort of looks like a double top rollover. Have you looked at that chart lately?
It looks a little concerned. I am long Amazon. I stuck it in the long-term portfolio and try not to look at it. I put a double-sized position on when it dipped on the earnings report, and I was like, I want to have some of this, so I bought half for a trade, half for investment. I sold the trade part. I'm trying to hold on to the investment part just because I kind of think about what Mark Cuban says. I think Amazon wins even if we go back in lockdown. It's kind of like a scenario when if you really take like a 20-year vision, yes, valuation is still not that attractive, but we know they can make more money. I just see this online shopping continuing, and it's going to benefit Amazon long term. So I'm trying to just plug my nose and hold on to my Amazon position, but I don't like the chart.
Yeah, the chart looks like a rollover after a hockey stick. Another thing that's going on here is that we've got an administration in Washington that has acknowledged that there's a big liquidity crisis, maybe even a solvency crisis. But look what they're doing with China now. They're courting another trade war. How stupid is that in the middle of a financial crisis spurred by a health crisis to threaten delisting potentially of Chinese equities in U.S. markets? This is insanity. That would be, Goldman Sachs estimates it would take 180 days to unwind Chinese equities. I don't think it's going to happen, by the way. But when you've got a president who's threatening the second largest economic power in the world with sanctions and delistings, that is very destabilizing for the market.
Not to mention that, there's some naval ships off Malaysia due to some tensions in off the seas there. We're on the line with Marc Chaikin of Chaikin Analytics. He joins the show every couple of weeks to give us his thoughts on the market. I just want to go to the IBB here, just back up at all-time highs here. XBI also. Now, when you see the all-time high made in the middle of 2015, and then you see the decline that it had and all the time that it took to get back here to all-time highs, I mean, are you looking for continued follow-through here? Or because if you're going, from a chart perspective here, you're really at a lofty level, right? Making the new all-time high. And for me, I think it's important. The biotech's important right now. We're working for a vaccine or a cure or something, but, is every single company that makes this up, are they all going to come up with a cure? Are they all going to benefit from this? I just kind of see it as it took this long to get back to a new all-time high. Why not lighten up? What's your thoughts on that?
Well, as I said, lightening up on some of these spikes after earnings is a strategy that I've been very forceful in proposing, and I would not buy them up here, but I do think if you want to put money into the market, that biotech is a place that is, if not a safe haven, certainly a group where the spotlight is favorably shown on it. That's why I think the QQQ is probably the best overall bet to play the long side on dips only, because you get a combination of biotech and pure technology in there, and you don't have to make that outsized bet on biotech.
Mark, what about just some of the ETFs that the Fed is coming in and buying here, the fixed income ETFs here? Do you have any thoughts on those going forward?
Too easy. If it looks like a free lunch, remember there are no free lunches on Wall Street. So HYG, I think you've got some risk there. There's a lot of bankruptcies coming, guys. A lot of bankruptcies coming. We know they're there in retail. We know they're there in energy. And by the way, that's why the banks are hurting, Dennis, because there's so much exposure in these various sectors. And I'm suspicious of a market that made it so easy for Carnival Cruise Line to borrow, for Boeing to borrow $25 billion. One very smart writer said, well, the Fed was very smart by backstopping these credit ETFs. They enabled Boeing to borrow $25 billion instead of going on a government loan or a government handout. Well, it's too easy. It's just too easy. That $25 billion could disappear in a heartbeat. They didn't get another new plane order last month. So I'm not a bear that I was looking for 1700, although it's still a possibility if every roll of the dice, turns up craps. But I certainly wouldn't defend the market if it breaks below 2600.
Mark, let's talk about just the economic recovery here. Almost every state in the country is either has a partial reopening or is set to reopen soon. Only about 6 or 7 states still have stay-at-home orders in place and are not going to lift them, or they haven't announced it at least. So with the vast majority of the country trying to reopen here, also we have jobless claims in 3 minutes. With the vast majority of the country trying to reopen here, what do you expect we'll see from the consumer, from spending, and the follow through of that into the market?
I said a month ago that the biggest risk to the stock market was a premature opening of the economy that fails and forces some sort of reversion back to not total lockdown, but certainly more stringent social distancing. I'll give you an anecdotal point here. They reopened the restaurants and the beaches in Florida. We have a friend in Naples, which is a really fairly conservative community. It's not, Fort Lauderdale at spring break. This is a serious community. They had to close down the beaches on Saturday because people were partying. So they had to reinstitute stringent hours, 2 hours in the morning, 2 in the afternoon. People are social animals. They want to congregate. And they're going to do it badly, in my view. We have the evidence in more states. In Florida, the restaurants were booming this weekend. People are sitting at tables. They're drinking with friends. That can only end badly. We've been told by the responsible scientists that this is not going away. And the further we get from social distancing, the worse it's going to be. So from the point of view of the economy, V-shape is totally out, in my view. It always has been. Completely unrealistic pipe dream. U-shaped, yes, but how wide is the U?
I guess that's the question. All right, a minute and a half here a half a minute, or about 1 minute until can't look at the clock, until jobless claims here. We are looking at 2.5 million jobless claims filed last week. That is the consensus estimate. So that would be the first time since this really started that we'd be under the 3 million threshold.
I'm not sure.
We've got 25% effective unemployment, so it's almost only so much blood you can squeeze out of a stone. Be interesting to see what they do every week, but I think 2 weeks ago the market rallied on the unemployment claims numbers. Mm-hmm. And if they don't rally this time, that'll tell you that we're turned. We've turned, and we're going to test the 20.
I think if they rally it, I think it's a rally to be sold. That's day traders out
agree
there. So
well, more than just day traders. If you're not 20% in cash, it's a spot to get some cash on the books.
Yeah. I agree. I think if you're sitting all invested here, I think, I'd be a little bit concerned. I redid my portfolio, my long-term portfolio, and I analyzed it all yesterday. And here, give the jobs numbers. We'll talk about that in a second because we're bouncing around a bit.
Futures are on their lows. They broke the Globex lows here about a
We're
half
right near
hour
yesterday's
ago.
low too.
Yeah,
All right.
87 even. We're trading at 90 quarter. There was a little blip there. Back over 90. 27.90 is what the level we're trying to control here. 27.86. That was your low from yesterday. Getting a little relief pop here. 27.87. So that's what your bulls are going to be leaning on here, is a potential double bottom here. 27.86, 27.87, and harken back to a month or so ago, we were talking about the 50% retracement of this entire move for the June futures. Boom, it's right there, 27.86. So there's your number. We've had a big sell-off. Now the bulls are leading here on this double bottom. See if we can get back mid. Yeah.
2.9 million was the reading for initial jobless claims last week. So at least we're going down, but we're still at ridiculous levels.
Yeah, one thing I would caution is these people who are touting numbers as, oh, well, they beat the estimates, whether it's earnings, unemployment claims, PMI numbers. This is all just bogus talk to get airtime. No estimates or projections mean anything in this market because nobody knows. Nobody knows.
Well, the other side of that is, what else does the market have to go off of other than an estimate? So
it's been trying to find reasons to rally. Like, I mean, you've got people trying to justify, why we had such a significant rally when you've got these economics numbers, and the economic numbers are showing despair. So you have a lot of media personalities that come on and they need to justify the prices, and they don't want to hear, that we're squeezing the hell out of the shorts, or it was just crowded to the bear side, and we're going to squeeze those bears for a while until they break. They want a fundamental reason to find it, and they say, okay, well, we beat the estimates, or they're trying to find the silver lining on why the market's rallying. But the bottom line is just, everybody was very bearish. You had a lot of people basically betting, on the initial pop that it was going to not follow through when we bounced from the 220 area to the 260, including myself. And, it climbed that wall of worry to punish the bears. Well, now you've had so many people flip the script and say, well, the Fed's there and we're going to go long no matter what. So I think you've actually squeezed a lot of the bears out, and you've caught a few people long.
I think so. We just broke those lows, by the way, Joel.
And the little rally that we had was sold. So it's turned. We're not rallying. Those numbers, weren't good. But a week and a half ago, the point you were just making, Mark, a week and a half ago, we were rallying even when the numbers were bad. Now we're changing our opinions a bit, and we're finding, not so much the silver lining, but we're looking
reality.
at, we're looking at the opposite. So this market is nervous. This market is raising cash. This market has reason to be nervous. It starts with, the virus, but it's also got the banks. It's got so many issues. Eventually, a lot of this just comes to roost. And that's why I'm sitting now in my long-term portfolio. I was going to save it for the thing, but I analyzed it. And I felt like I was in the 60s, but I hadn't actually sat down to the calculations. I own 80 stocks or something in a long-term portfolio, and they're in multiple accounts. So I had to just actually sit down and quickly do the math. But on the math, I'm actually sitting at 71% cash now, 71%. That's on my liquid assets. That's not including real estate. If you throw real estate, I'm even more. But on my liquid investable assets, I am 71% cash. And as a trader, I'm short. So in my trading account. So you can tell, my bets are still that we have more pain ahead. I would never sit with 71% cash when I'm 43 years old if I didn't think there was pain ahead. But I'm very nervous about this market.
Well, and you're in good company. You've got people like Stan Druckenmiller and David Tepper, who are, Kramer credits Tepper for the tip-off at one of the conferences that turned him bearish. Of course, there's a weather vane effect there. That bear could be a bull in the next windstorm. But
Kramer's bearish?
No, but that was in
Kramer's
late
been
February.
bearish.
Tepper whispered in his ear in late February, but then Tepper's out there again. And these guys are typically talking their books, so I always discount what they say. But, when they make sense, that's a different story. And one's talking valuations, one's talking a different game in terms of the economy. But however you look at it, there's risk and uncertainty in the market. So just your listeners, your viewers should prepare for that. Doesn't mean you go 100% in cash. I think Dennis
I'm probably too high. I'm just, I'm a trader. I'm very glued in. And like I said, and, Josh Brown was making a good point here too. I flip around. I sold, and we listed this off, like 8-9 stocks out of my investment portfolio last week for the simple reason that some of them had just run too far.
Yep.
I'd sold Shopify out of my account because it had run too far, in my opinion. And obviously it's still holding up. I sold Target, not because I don't like Target in this environment, because it's run so far that it's approaching the all-time highs. And, even though it's a safe hiding spot, I think eventually the market gets ugly enough, they start to sell off everything. So, the reason I'm back up to that much cash, which is probably as high as I've been, is probably because a lot of my stocks that I had, some of these tech stocks, had run too. And I just feel like it's not that easy of money on the long side now.
I agree. To that, I'd add stocks like Peloton and Zoom and Chewy, great brands, but
at a certain point, they've just run too far.
Which one?
I'm just saying, at a certain point, those stocks, have maybe just run too far. Is Peloton a $15 billion company? I mean, and valuations never mattered in this market. So, we can't necessarily, the story can carry a lot farther than valuation. But, it wasn't a great candle for yesterday on Peloton. Eventually, some of the money hiding out in some of these places could get hit as well. There's a lot of money. I want to get quick thoughts here. And I was mentioning this earlier, just in the chat. Quick thoughts on the gold miners, because GDX and GDXJ has had a significant rally, getting all of its losses back from March. GDX is actually higher than it was back in March. And a lot of people think, well, gold benefits from this. No matter what, we're going to be safe in gold. I was arguing gold is a different animal than the GDX. You have to consider one thing, is that the miners have a lot of debt. And if we go into a financial crisis, and I'm not saying we're going to, but it is on the table, especially when you see these banks, you could actually see some of these gold miners get hit just because they're levered up. So thoughts on the gold miners, because it looks to me like that GDX is topping out.
You certainly have a momentum divergence in the various technical momentum indicators like RSI and stochastic. If your assumption that there's a lot of debt in there is true, then you may want to go for a couple of the gold mining stocks that have
you could pick on a
better
couple
balance
stocks
sheets.
individually.
You can pick them up.
Yep.
We've got bullish ratings on a number of the gold stocks. I typically don't watch them as closely as I do the tech and biotech stocks.
Me neither.
There are a couple. So I think it might be time to get out of the index, the ETFs, the Van Eck ETF that you were just looking at, and maybe look at some of the individual names. And there you just check the balance sheet. For instance, in Chaikin Analytics, you can see the debt equity ratio is one of the 20 factors in the power gauge. Do we have 1 second? I'll go into metals and minings. And
go.
I know we've got 1 or 2 gold stocks that look interesting, but I got to do a little bit of drilling down here.
I just see what they did in March. I see, and charts can tell you a lot of stories. And when we were really concerned that this was really going to get ugly, they start selling everything, any kind of stock. Gold, got hit as well, which was actually surprising back in March. They were just literally raising cash wherever they possibly could. But the gold miners themselves got hit a lot harder than gold, which is always the case. So, GDXJ fell from 40 to 20 in about a week and a half. It got cut in half. It is all the way back up here now. I think people are hiding there thinking that they win no matter what, because here Fed's printing money, so that's going to be good for gold. But the one consideration, I'm going to say it again, is gold is not gold miners, because the miners are stocks. And these stocks are levered up. A lot of them are really levered up. At least the last time I was checking balance sheets on the gold miners, there's a lot of leverage there. So that's still a consideration.
I just found one that we like, SSRM, with a bullish rating that has, a very reasonable amount of debt relative to equity compared to the rest of the group. So if you dig deep, there are stocks in the gold mining area that have better balance sheets. And that, if you want to continue to play it, I think you make a good point that there is risk in just buying a whole index. It's not purely a gold play, but Newmont Mining has very little debt relative to equity. So I think you can find individual names that still look good technically, where you're not playing the credit risk.
All right, Marc Chaikin is the founder of Chaikin Analytics, joins our show every other week. Marc, thanks for the time, and keep staying safe.
Thank you.
Oh, I just cut him off. Sorry about that, Marc. All right,
Thanks,
8:40 here. Let's go to a couple earnings. Let's do Cisco here. Cisco.
Before we go, I want to get
Yeah.
Joel's thoughts on this GDX
All right.
and GDXJ, because it looks tired to me. I mean, it could be consolidation just to go higher, but with the banks going down like they are, I think this is just a nice setup. I think it's a nice setup for the short side on GDX and GDXJ.
Yeah, you know what? I picked up some of these in the middle of February and just watched them get slaughtered with the market. And then now
they came all the way back.
And I mean, they're just not going. You know what I mean? And in this kind of environment, yeah, and would people have to liquidate? So I mean, gold's been hanging in here. I wish I would have just bought the gold instead of the miners. I'm just getting sick of looking at them. I mean, if you're looking at them from a short perspective, you got an area to lean on. You know, you're at a multi-year high. I'm just looking at the GDX here. If you want to short them, you know where your out is. I don't know. I just don't. Gold is so weird because, like, when you want it to perform and you want these money to perform, markets going down, then they just treat them like stocks, you know. And then the market rips, and they're like, "Oh, who needs gold stocks?" So, I mean, gold had its run. I know my dad was following it back when it was like 200-300. He followed this guy named Harry Brown and everything, but it's just not happy with the performance. And you know, I see what you're saying here, setting up with a potential short. For the GDX, I definitely see you're out.
Yeah, I see my out too, and I'm setting it up here. I have no position on in any of these here at this point in time, but I might initiate a short in the GDX or GDXJ today after the open here, or maybe even after the show. I'm just looking at it here. 35.50, would be my out on the GDX. 35.56. So if you're shorting here at 33.90, you're risking yourself $1.50. I'm banking. I would be saying that I think it gets uglier for the overall market, and eventually that sinking, we say rising tide lifts all ships. So, it's, I don't know what the opposite of that would be, but I think they get dragged down with the overall market eventually if the market continues to go down. So obviously the market turns around. That's a different story, but money hiding here. There's money hiding here. There's money that really believes that I'm safe in the GDX. I'm just going to say, look at the chart in March when GDX was 30 and it went down to $16 in a week and a half. History can repeat itself. Same thing with the preferreds. People who are hiding on the preferreds right now are in a wrong hiding spot, and I am short some of the preferreds. I talked about it yesterday. I'm going to say it again. The preferred stocks, the PFF, when you look at that index in itself, and I full disclosure, I am short the PFF, just is full of bank preferred stocks. So if you start to have problems here, look at what it did back in March and look at where it is right now. It looks like it's ready to fall off the cliff for good reason. Now, again, if the market turns around, PFF will just start to climb, but PFF isn't going to rip up to 36, 37, 38 on you. It's conservative on its way up, but it can be violent on the way down. So it's kind of nice on the short side if you time it right. Again, timing is always critical. If you're shorting individual preferred stocks, it's a tough game. Like, I've looked at individual preferred stocks and I just want to throw out some numbers at you. Like, you think naturally, okay, well, I'm going to short a bunch of Wells Fargo preferreds, which I am short a couple, but some of these things are like the borrow rates are like 30, 20, 30, 40%. They can just get out of hand. So you got to look at what the borrow rate is before you just start shorting individual stocks.
Right.
If you go to the preferred PFF, that thing is very liquid. The borrow rate's probably, I can bring it up right now. It's probably next to nothing. I'm just going to bring it up on my platform. Yeah, it's 0.63% a year. So it's basically nothing. So, the whole year, if you hold it for the entire year, you only get charged 0.63%. But on some of these borrows, like there's a GS.PRJ, it's 85% the borrow rate. So at least, at Interactive Brokers, I'm looking at it. So, you've got to be careful when you're just shorting them. And then obviously some of them are just hard to borrow. PFF's always liquid, so it's the cleaner play, the easier play. I like PFF from the short side. I like the miners from the short side. I'm just setting up some trades for you. If you're looking at, what hasn't got hit yet, they haven't got hit yet. If this really turns ugly, I think they get hit.
And just to wrap this up, I was just looking at flows here. The GDX has had $630 million of inflows in the last 3 weeks. So
I just want to clarify. Yeah. So say that again. Say that again.
yeah, $630 million of inflows. That's money going into the fund, into GDX in the last 3 weeks.
They're hiding there. They're hiding there. It's crowded. I love this setup from the short side, to be honest with you. I love it. So I get trading ideas, sometimes, and sometimes they're good, sometimes they're not.
You get them
I know
all
where
the
my
time.
out is. I have such defined risk on this, and it's setting up like the ducks are all in a row. The chart looks good. The banks are going down, and people. Okay, I want to say it again. So people are asking me if I'm short gold. Do I think the banks reverse? I'm not talking about gold. I'm not talking about GLD. I'm talking about the leverage and the miners. I'm talking about GDX and GDXJ because there can be a disconnect. We've seen this happen if we get into a financial crisis. I'm not saying the financial crisis is coming, but here's a low risk play to, basically bet on it. I think a lower risk play. So because if the banks continue to get ugly, don't kid yourself. Those miners will get hit. I'm telling you, if we see Wells Fargo fall another $5-6, I'm not saying it's going to happen. There's a lot of risk to come in here and short Wells Fargo now, though. It could turn around on a dime. I don't see the major risk in shorting the GDX at this point in time. You know where your out is. I would say if it starts to make new highs on the move, okay, my thesis is wrong. So I like the setup.
We hear you. Spoos continue to leak here. Just cut through yesterday's low like a hot knife through butter. Got to 27.77. This is it's reminded me back of March here. Just no pop off that number at all. A little bit of reality setting in here in the markets. Let's see if we can get back above yesterday's low here at 27.86. But just a slow leak here in the markets, and we'll see. Does not like a good day. I mean, Spencer, what's your tally on let's see your signs. When's the last time we had a limit situation in the market?
That sign's been retired. I guess I may have to. I may have to bring it back. I may have to bring it back. It's been I haven't been keeping track this entire time. Come on, it's been like a month and a half or something.
Yeah, well,
since we've had a limit down or a trading halt. So I may have to bring that baby back if we get more volatility here.
I don't think we're at that point. I don't think there's that much fear out here. But I think we're at a point where I'm now a seller of rallies and not a buyer of dips. I was buying dips and selling rips. I've been saying that, I've been saying it for weeks. Buy the dips and sell the rips. Buy the dips and sell the rips. I'm not buying this dip. Yes, and people were asking me 2 days ago. I got a million messages not a million. I'm exaggerating, obviously, but I got 4 or 5 texts and probably 4 or 5 messages, even on Twitter, but email, text, probably a dozen. 2 days ago when we fell down to 287 are you buying the dip on this one? You could just feel it was different. And, I said it yesterday on the show when we were rallying up, you could feel it was different. So you could feel that it kind of turned. Why? Because they weren't just selling the crap, the trash stocks. They were starting to sell the leaders. And when the leaders start falling, and the trash is still going down, it's going to pull it all down here. And why did they start selling the leaders? Well, they got tired. Apple got almost to all-time highs.
Do you still have that short?
All-time highs.
Do you still have that short?
I know I covered it.
I told you not to cover that.
Never cover. Those are trades, though,
I told you not to cover that one.
Those are trades. Here's my analysis here.
Where did you cover it?
Analyzing it here, I'm 73% or 72% cash in my long-term portfolio. And I asked my wife, if you were sitting with 72% cash, what are you looking for the market to do? In your long-term portfolio, you're 43 years old. What are you looking for it to do? You're looking for it to go down. So to be flat out short everything as well, yes, in my trading portfolio, I'm going to flip around and I have some shorts on. I've said, I'm short some preferred stocks. I'm thinking about initiating a short on the gold miners. I haven't put that one on yet. I am short some stuff.
You're avoiding the question. Why did
I covered Apple yesterday at 304?
Okay. And what did I tell you to do?
Don't cover at all. Joel says never cover.
I said put a stop in above and let it take you out.
You get stopped out on this stuff. You see some of the wicked little rallies in Apple there? It went from 308 to 316 yesterday morning. It was 308 in the after hours session. Then it sells off. And even at the end of the day, it was down at 302.
I know. You did. I'm just giving you a hard time.
I love Apple still. So, obviously I still have it in my long-term investment portfolio as well.
So you were hedged.
Yeah. But anyways, I still like tech. If you looked at my long-term investment portfolio, here's my core holdings. Apple. Now it's Amazon, which, I've still kind of, the valuations always kind of turn me off. But I think about what Mark Cuban says. I think Amazon wins no matter what. So I've got Apple, Amazon, Google, I have Microsoft. And then, so a lot of the big guns, those tech rich cash that are going to perform no matter what. So of the 27% of stocks that I have, and then I have a huge position in Qs from the financial crisis that I'm up like, I don't even know. I bought the QQQ. I think I'm averaged in at about $40 and it's 217. So it's a huge position. It's, I believe, the biggest position in my investment portfolio, just simply because it has grown so much. So obviously I'm very heavy tech still of the 27%. But that's not saying I'm bullish, tech stocks overall, because I'm still sitting with a huge amount of cash, because I'm concerned that we have problems. I may be wrong, and maybe the market rifts back to all-time highs, and I'm going to be on the sidelines for it. But everything from an economic perspective here, which hasn't mattered up to this point in time, tells me that I don't want to be fully invested. So, and I will never go, I'm never going to be one that's going to be 90% invested or 100% invested in equities. I'm always going to have, where I'm really, why I have so much cash, to be honest with you, is the fixed income portion of my portfolio is almost nothing. It's down to like 1%. And that was full of preferred stocks. And why do I want to own a preferred stock right now, a PFF? And obviously you say, oh, you can own bonds, but bonds are a tough game too, because you're in this low risk environment. You're going to get 2-3%, on a government, or not even a 1% on a government bond. You go to corporates, you get 3 or 4. I don't want to loan money to Boeing at 4%, or I don't want to loan money to some of these companies at 4 or 5%. The risk reward isn't there. So I've always went to the preferreds to try to pick up a little bit extra, but the preferreds look ugly right now. So from a chart perspective, from an investment perspective, and yeah, it's still got whatever, a 5.8% dividend, the PFF, but it's a tough gig when it's full of bank preferreds and the bank stocks are collapsing. I think eventually they could go down too. So the majority of my cash, why I'm in a lot of cash, and I went on a long run here, is because I'm not confident enough in fixed income investments right now, besides government bonds.
You're not happy in the company.
To be, I don't want exposure. So in that way right now. So I'm not for 3-4%. I'm jumping into, like Upwork, which I'm still in, which I'm going to be probably selling here because this has ran so far. I'm in stocks like that. Those are speculative, where you can make big money. It's huge risk, huge reward. I think the reward on the PFF is 5.86% dividend. I think the risk is enormous. So I don't want to own any preferreds here until I know that we're coming out of this. And then I'll rebuy my preferred stocks. So if you're sitting there hiding out in PFF, I think you're in trouble. I think you could be in trouble.
What about Norwegian Cruise Lines? They reported today.
Yeah, let me get those numbers here. I didn't have them up in front of me. So NCLH, right?
They said everything right. There was Norwegian. I get the numbers, but they said on Jim Cramer. Remember he came on Cramer 3-4 nights ago? People watched that interview on Cramer. He's up there talking about how the cruise, our bookings are up. They're up year over year on 2021. He's saying all this good stuff. And we're raising, and we have a comfortable position that we can handle this in the next year, no problem at all. Well, why isn't the stock rallying? Give me the numbers.
EPS loss of 99 cents last quarter versus a loss of 31 cents as the estimate.
With 2.5 good months.
Yeah. Well, yeah. Sales of 1.2 billion versus a 1.18 billion dollar estimate. So I know Marc says to discount the estimate, but that's what we have to go off of here. So the headline numbers, the earnings were horrible. The sales were okay. CEO talked about all the actions they've taken, blah blah blah. But yeah, saying all the right things, like you said.
Saying all the right things. That was an interview that I felt like, wow, maybe we should buy the cruise lines after that. It's went straight down since then. So obviously, maybe he's telling a different story than what investors are seeing. I'm not buying the cruise lines. I'm not touching cruise lines. I'm not touching airlines. I'm not touching Disney. And yes, Disney has gotten a pass here for a long time. What do you think of the Disney chart here? We lose 100 on Disney. It could get ugly again.
I just don't see.
I can't fathom how Disney, this is how insane this market is. And, I've been ranting a lot here today. Disney is at the same place that it was a year ago. It's the same price. And the Disney Plus, but, that helps a little bit. But come on. What is Disney Plus of the overall revenues? 1%? 2% maybe? If that. Those parks you said are 35%. Those parks are not going back to their attendance numbers that they had. In my opinion, those parks are not getting back to those attendance numbers that they had in January and February for years. They're burning, somebody said they're burning $1 billion a month. I don't know if that's true, but they're losing a lot of money. You think about the parks being closed. This is a serious situation. All of their other businesses, the movies are shut down. There's a lot of problems with Disney. People say, how can you go wrong with Disney at $101? This franchise is awesome. It's an awesome franchise. Under different circumstances, I would be backing up the truck and buying Disney stock here. But this is a different world here right now we are in. And until people get, comfortable doing everything they were doing before the pandemic started, stocks like Disney are going to suffer. I don't want to own Disney. Not until I have some
under the circumstances. They popped it on that Shanghai plant being open a little, or the Shanghai park being open for a little bit.
Because they sold out on day one.
Yeah.
And then somebody else was tweeting out that you get lots of tickets on day 2, 3, 4, and 5.
Yeah.
Well, and they sold out
at 30% capacity.
No, not even. It was less than that. It was, a fraction of capacity. So.
And we're reopening Disney Springs. So we're opening an outdoor mall. I'm sorry. I love Disney. Great franchise. I love the company. My kids love Disney Plus. They love all the movies. They do a lot of things perfectly well. They're a victim of what we are in right now. And they will stay a victim until we have some clarity on how we're getting out of it. And I agree with Mark. I've been saying on the show, I don't think the reopening is going to go well. I think people are just going about their business. They're starting to go about their business because they're sick of it. I'm sick of it. I don't want to sit in my home all day. I'm used to sitting in my home, and I'm sick of it. Are you sick of it, Joel? Spencer's sick of it, I'm sure.
Yeah,
we're all
of course,
sick of
man.
it.
And I started a couple weeks before you guys did.
I started early too. I started beginning of March when Spencer got sick. I'm like, okay, I'm done with this going to school.
Yeah.
I pulled him from school, and that was it. And because I knew, you knew it was coming. The writing was on the wall. This wasn't like something that we didn't know was coming. We knew this was coming. So I didn't want to take a chance. But I'm sick of it. I want to go back to my normal way of life. I don't think it's safe. I don't think it's safe for me to just go. There is a percentage of the population that believes it is safe. Maybe they're right. Maybe COVID is just the flu. But all the numbers are telling us it's not. I'm going to believe the doctors and the numbers, and I'm going to stay safe in my home here. And even if they tell me it's okay to go out, I'm not going to go out until I stop seeing people get sick. That's just me. There is a percentage of the population that is like me. So even if you reopen everything, like they have in Sweden, there's still a percentage of the population that isn't going about their business in normal ways. I know we had a person from our chat that's saying it's true, but the numbers are saying that's not true. So I'm not completely convinced that we just reopen, everybody just keeps going about their business. I think there's a good chunk of the population that will still be spooked.
Well, we're going to find out here because, like I said, the vast majority of states are trying to reopen. They either have a partial reopening happening or a partial reopening happening soon. Only a half dozen states don't have reopening plans right now. So we're going to find out in the next few weeks how this goes and whether the numbers get worse or whether the reopening worked. We're going to, one way or the other, we're going to know. So
we'll know eventually. It could look okay for a couple of weeks. It could look okay. Not everybody's going to get sick right away. Maybe it's going to go well. I hope it goes well. I want it to go well. I want to be wrong. I want to actually, see the market go higher and my cash, be a bad call. I want to do that. And that's because I don't want to be locked up anymore. I value life more than money. So I want to get out. I want to go back to the normal way of life. I personally don't think it's going to be that easy.
All right, 8:59 here. Do you guys want to cover like one more, like Cisco or something, like one more stock before we head out for the day?
Sure.
Yes? No? Okay. Cisco earnings. They had,
maybe you guys should stay on because they're saying it was a DDD show, and I've been talking.
No, I got to hop. Actually, let's just
while.
do this, and I got to hop. I'm hopping over on Hot Mic for the next half hour.
So you can listen to Joel.
I got a lot to say. I didn't say much during the day, but I'm just gonna. I took a little nap, so I'm going to be good and ready to go for this today.
Right,
but go ahead.
Fine. All right, I'll give you the Cisco numbers real fast. The EPS beat, the sales beat, and they gave guidance for the quarter, which is good to see. Someone give guidance. Joel, thoughts on the chart?
They popped and then it dropped is what I saw. So that's not good. Full disclosure, own Cisco in the low 40s.
I do too.
Wish I would have gotten rid of it. It's on the rebound from the pre-market low. Pre-market low comes in at 41.31. You're back above $42. So looking okay here. I don't know. It's had a big range, so I just would keep an eye on the closing price. If it stays green, it's good to go north. 44. If it gets back anywhere near 44, it had a pop over there. That's going to be big resistance there for Cisco.
All right,
I
everyone.
got it in the long-term portfolio. It's been a dog, barking dog. It's a 3.4% dividend. It's good. The value tech play, yes, they have Cisco WebEx, but it's not picking up the slack that much. I kind of don't like it, but I still have it in the long-term portfolio.
All right, that's a wrap, everyone. Thanks for listening. Catch our podcast. Please remember all of the information from our show is meant to be used as informational purposes, not for investing or trading advice. We'll be back with you this afternoon. In the meantime, stay safe and good luck out there. Okay.